What's up, Team Tackle? This is Coach Matt from Tackle Trading, and it is a pleasure here tonight to introduce a good friend of mine, a credit spread expert. Coach Greg Holmes is here with us tonight, and he is going to be teaching us a little bit about the bull put and the bear call credit spreads. He's going to introduce those credit spreads. He's going to get into why he loves them, and he's also going to spend a tremendous amount of time in Thinkorswim tonight, kind of showcasing how to do it for yourself, identifying certain support levels, where to sell under. And I won't get into it because I know he's going to get into it here tonight. And right before we get into that, Greg, if you'll go ahead and show the slide here a little bit, we got a couple things happening right now at Tackle Trading. First and foremost, it is always a great time to become a pro member of Tackle Trading. You can do so for free over there at tackletrading.com. Sign up for a free trial. If you are interested, we are also having a holiday sale right now, and it's a great time to become a pro member with an annual pass. Don't worry about that monthly. We have that on a substantial discount right now. You can check that out at the storefront at tackletrading.com. And last thing I'm going to say before I turn the time over to Coach Greg, yes, I have an amazing webinar of my own coming up next Monday at 8:30 p.m. Eastern Standard Time. This one is not on YouTube. It is a registered webinar as we are going to go through covered calls. And yes, I'm going to teach covered calls because cash flow is the name of the game. We're going to be talking about cash flow tonight. We're talking about cash flow next Monday with covered calls because 2025, nobody can tell me what direction the market is going to take in 2025. But if you know how to cash flow, it doesn't matter. And that's the beautiful thing about Tackle Traders. We're going to help you do it. So come over there and be a pro member. Register for my webinar next Monday as well. And with that said, Coach Greg, one of just the best of Tackle Trading has to offer. He is an amazing cash flow expert. He focuses on credit spreads. He does a lot of other things as well. But with that said, guys, I hope you have an absolute wonderful time with Coach Greg here tonight.
Thanks, Coach Matt. Welcome, everybody. Super excited about this. Credit spreads is it's one of my favorite strategies. I had a few mentors of mine teach it to me probably 10, 15 years ago. It's been a staple for me. It never changes. And there's a host of reasons why. We're going to go through some examples tonight. I'm going to build them out. I'm going to explain the risk graphs. Going to explain why I want to do credit spreads versus some other type of spread or some other type of directional type of trading. There's keys to all sorts of different types of trades in the market. Cash flow, especially the credit spread cash flow, it's so versatile. It can be done in up markets. It can be done in down markets. It can be done in neutral markets. It can be done bearish. It can be done bullish. It can be done aggressive. It can be done passive. It's just one of my favorite strategies because it fits so many areas of the market. I'm going to explain why I'm going to get into a credit spread now versus doing some other type of trade. I'm going to show you guys how I build them out, how I think about them, how I manage them. It's not just about getting into a credit spread. It's what you do with that credit spread once you're into it that really makes a big difference. So very excited tonight. Happy to have you guys out here. Thanks again, Coach Matt. Please, you know what? If you really want to learn this stuff and really dive into this, go to tackletrading.com. I've been a coach there for a long time. It's just a great community to learn and grow with, and we'd love to have you. So, without further ado, I've got one of the big dog stocks up here tonight, NVIDIA. Now NVIDIA's has some trial and tribulations recently, and honestly, if you've been watching the sectors at all, semiconductors had its beat down recently, but it's actually held up pretty well, generally speaking, in the market, and that's really kind of the first focus is what areas of the market do you want to play in. So before I start going into a credit spread or looking for credit spreads or any type of trade for that matter, I got to find the areas where I think there's opportunity. And so right now, when we look at there's only two or three sectors really that are giving us bullish opportunities at this point in time. I'm not going to go through all the sectors, but if you did go through the sector ETFs, you'd notice that communications, tech, and potentially consumer discretionary. Those three areas right now are actually offering opportunities from a bull perspective. Okay. Now, the bull perspective, because of the recent volatility we had a pretty big, event with the Fed last week. There, with those events, we've had these pullbacks in the market. So now we've got, especially NVIDIA here, building some support. So this is the first thing we got to look at. So first off, if I'm going to trade bullish, I need a bullish trend. Okay. Well, if I look from left to right on this chart, okay, you know, a year ago, this thing was 47 bucks. It's now 140 bucks. I don't think anybody would argue with me and say that's not generally bullish over the course of a year. Now, obviously, we have long-term perspectives, maybe a year, 3 week, 3 year weekly, whatever you want. We have intermediate, which is, anywhere from 6 weeks to a couple of months. Okay. Well, the last couple of months, you could say that NVIDIA is kind of neutral. And then the last couple of weeks here, you could see that there was a pullback. You could even say it's slightly bearish for NVIDIA. Well, what I'm looking at here and why I'm excited about potentially building a credit spread in NVIDIA is because we built off this level of support right here. So old resistance, old resistance, old resistance, now new support here, here, and here. And now we've got this fire off today. So today's candle pushed right up to this 50 period moving average. Okay. Now, some of you may use moving averages as technical indicators. Some of you may not. That's fine. It really doesn't matter how you do it. It's what you determine from your own technical analysis. If you want to learn more technical analysis, like I said, slide on over to tacotrading.com. But for this one, because we got this base formed and it fired off, it got above this purple and this red line here, which is our 9 and our 20 moving average, something, again, we use at Tackle Trading here. We fired right off, and now we're at this precipice. Okay. This 50 period moving average can act as support, which it did here. It can act as resistance, which kind of got to look back a ways there to find some resistance potentially there, I guess. But the moving averages can act as support and resistance. So the reason why I'm looking at this now for potentially a cash flow play, like a credit spread, like a bull put spread, is because I don't know if if NVIDIA is going to fire off to this next level of resistance, or it's going to go sideways, or even it's going to pull back. Okay. So if I were 100% certain that this was going to go from 140 to 150, then directionally speaking, I would want to be very aggressive on my directional play. Okay. I might want to I might want to just buy a straight option. However, because I have some uncertainty here, I do think that NVIDIA is bullish overall, right? Generally bullish. Okay. I do expect some upward movement in price, but I can't be certain. But what I can be certain is that if I use a credit spread, one of my favorite trades, I don't actually need it to go up. I don't actually mind if it goes sideways, and I don't even mind if it pulls back a little bit. Okay, now if it craters, that could be a problem for our trade. We'll talk about that in a second. But the beauty of the credit spread and the reason that it's one of my favorite strategies is because it gives me three opportunities or three ways to profit. Okay, any trade that you look at, whether you're doing a stock trade, option trade, futures trade, whatever it is, okay, it can only do one of three things. It can go up, down, or sideways. That's it. Well, if I can set myself up a really cool trade where I can prosper if it does go up, if it just meanders sideways, or if it goes down, if I can set that up, doesn't that give me a leg up? And the answer to that is absolutely yes. Okay. So now that I've kind of got a trend that I'm working on, I've got a bias, an overall bullish bias on this. I've got some confirmation here off of this level of support here. Now's when I want to start looking at a trade. And the reason I'm not getting really aggressive is because, again, I don't know if that 50 is going to hold this down. And if it does, I don't want to put myself in a position where I got too aggressive on the trade. So what I can do instead is I can set up what's called a bull put spread. Okay. I'm going to show you what that is. Now, bull put spreads. Okay. When we look at bull put spreads, what we're doing is we're looking for a bullish trend. We're going to use put options and we're going to spread them. What that means is we're going to set this up so that we can get paid to put this trade on. That's the spread part of it. Okay. You can call this a vertical spread, and we'll talk about that in a second. We're going to put it on and we're going to get paid to do so. Okay, we're going to use put options because that's the way we set it up best. And then obviously it's got to be bullish. For me, there's for everybody. There's three basic ways to do credit spreads. You can do in the money, at the money, or out of the money. Most people are doing out of the money credit spreads. For me, because I'm not super bullish on this, I'm just mildly bullish on this. Out of the money is good. What out of the money means is I'm going to set my spread up down here in this range, okay, because I've now got levels of support. I've got moving averages as support. I've got this as support. Potentially, I don't know if we'll get that far down, but potentially this could act as support as well. And if I'm going to get these bounces off support, that's going to be good for my trade. Okay. So for me, anybody who knows time decay, theta, okay, anything 45 days and less, theta starts to accelerate. What I personally do with my credit spreads is I like to look closest to 30 days. Okay, so in the case of NVIDIA here, and the liquidity is important, right? It's got 175 million shares traded today, so it's got lots of liquidity that way. What we're looking for is liquidity in the options. What that means for those who don't know is we want tight bid-ask spreads and we need lots of contracts of volume and open interest. Well, if we look at these here, okay, this open interest, hundreds and thousands of contracts of open interest. That means people are trading these, okay? And that's one thing. I don't want to trade something that people aren't trading because then it can cause me problems. Well, volume, this is actually what transacted today. So 1,765 of the 138 put options were bought or sold today. Okay, that's activity. Okay, so now I can go out to the 32 days to expiration here, or I could use the monthly. And some stocks you may have to use the monthly. You can see that there's a lot more volume in the monthly options here, so that's always a good thing. Like I said, I personally like to go out 30 days or closest to 30 days. In this case, it's 32. If you wanted to use a 25, I'd have no problem with that either. But let's build out one of these trades, okay? So I'm actually going to use the monthlies just because yeah, like I said, I like the liquidity of it. All right, but again, if you wanted to go out 30 days, no problem there. Now, what we're looking for when we build out a credit spread, if I'm building out a credit spread, okay, an out of the money credit spread. When I say out of the money, what I'm doing is I'm going below the current price, okay? I'm going below the current price to build this spread out, which means I'm giving myself a cushion, okay, a cushion before the price of the stock, even if it started to fall, as I talked about here, I'm giving myself a cushion before my strike is hit. So I've actually got to get a few more strikes here. So what I like to do, I'm going to go out to, I'll put 40 strikes in here. What I like to do is I like to go around a 20 delta here. Okay. I like to look for a 20 delta. Well, we got a 21 delta and a 19 delta here. Okay. So what I'm going to do is I'm going to sell the closest 20 delta. You could do either one here. I'm going to use 128. Now let's go back to the chart for a second and look at this. Okay. So look where 128 is. 128 is right at this level of support. So again, if I blow this up a little bit, not only do I have the support of the 9, okay, the support of the 20, okay, right there. Now I've got this other level of support that this just bounced off of. So what's the likelihood that this could come back down and bounce again? It's not guaranteed because there is no such thing as guaranteed, but it's possible that that it is going to bounce off this 128 level here. Okay, and so for me, that gives me a little bit of sleep well at night kind of thoughts because there is that potential for that support. So what I do is I go down to 128. Now I can choose, the beauty of options is I can choose my other strike price. So I'm selling this and I'm collecting right now, I'm collecting a $2.03 credit. Okay. Now if I just sold this option, this put option like this, that's called a naked put. And there's unlimited, basically unlimited to zero risk on this. Way too much risk. So if I looked at this, if I confirm and send this, okay, um, the max loss on this is almost, well, 12,000, almost $12,600. I'm not willing to take that risk on this. Okay, I'm not sure that support will hold, so I'm not willing to take that risk. So what I do instead is I go buy protection. I use some of this money that they're going to give me and I go buy some protection. Now I always go $3 away. Okay, now there's nothing magic to that number. Okay, there's nothing it's not an arbitrary, it's just an arbitrary number. I like to start at $3 and then I can massage it the way I want it. Okay. But what I did basically is I went and I sold the 128 and I said, okay, I'm now going to buy the 125 put for protection. What this says to the market is I'm giving somebody the right to put me their shares at 128 bucks. That's what a put option is. And then I'm turning around and I'm buying the right to put my shares to somebody at a buck 25. So look at the difference in my risk. You guys remember the risk was 12,600. Now when I do this, my total max loss risk for this trade, 244 bucks. I went from massive, massive, massive risk down to 244 bucks. Okay. That's why we do credit spreads. That's one of the best reasons. Now, sure enough, for that $12,600 risk, we were getting $2. Okay. But now to take $244 risk, we're still putting ourselves in a position to make $56. Okay. So there's always give and take in the markets. That's just the way it is. Let's look at a risk graph of this. So this is a graphic representation of what this trade looks like. Okay. So as I was saying to you before, I'm going to actually put these slices, set these slices to break even here. Okay. So what this is I've set this up so that if this stock stays anywhere above 127, let's make sure I get that right. 127.42. If it's anywhere above there between now and January 17th, okay, we get to keep that 56 bucks. However, if it gets past here, okay, we could lose that 244 bucks. Okay. So what this is, now let me show you this. Okay. So I'm going to add another price slice here on Thinkorswim. Okay. So when I move this price slice over here, okay, I've got basically this 16% plus this 58%. So I've got what do I got there? About 80, right around 80%, 75%, something like that. I got a 75% chance that this stays above this price. If it stays above there, like I said, I get full boat. I get to keep the cash. Okay. However, there is a chance that this is going to fall down, and I have to make sure that I'm prepared for that. Okay. So one of the beauties of credit spreads is you can really reduce the risk, and you do have a very high probability of winning on the trade. The problem becomes is if it goes against you and you do nothing, that is a big old big time loss. And so we don't do that. Okay. We at Tackle Trading, we don't do that. I don't do that. You never let these get too far out of the way here. Okay. So with this one here, there's basically three places that I will stop out of a spread. So as I talked about, 128 here is our line in the sand, if you will. Okay. This is our tap out point. All right. So if it gets to 128 and it breaks through here, I know that I'm kind of in trouble, because if I lose this support, well, the next actual support is way down here. Okay. There's a big range in here. Well, if we go back and look at this here, okay, if it gets all the way down to that 115 range, I'm losing a minimum of 100, 170, 180 bucks to make 56. Well, I don't want to do that. Right. So what I do instead is I have three tap out points on a credit spread. I'll get out at the short strike, which in this case is 128. Okay, right there at 128, I will close the spread and move on. Well, if that spread got there tomorrow, which I'm not saying it would, but if it did, I'd lose 73 bucks. Okay. Well, if I can make 56 and I only lost 73, but yet I have a 75% chance of winning, then over time, mathematically speaking, that's a good system. Okay, that's how you can consistently make money on spreads. Now, if I wanted to give it a little bit more room than the 128, I could go to this break even price here where it crosses this zero line, this blue line here, and I could get out there. Okay, and that would be 127.37. I'd be losing about 80 bucks at that point. Okay, so that's tap out point number two. Tap out point number three in the final leg, absolute must do something to change the nature of the trade is what we call the theta switch here. So where this blue and purple line meet, okay, I'm risking about 85 bucks at 126.60. I would not let this get anywhere near 126.60 without closing the trade out and taking the loss. If you do that, if you take max loss on these, You have to win so many to get that back that mathematically this becomes a nightmare. So remember, yes, these are good strategies. Yes, you can do well on these. Yes, they're high probability, they're high probability, low reward. You can do very well on them, but you have to manage them. These are not things that you just go, I'll just throw it on and see what happens. Okay. But we can set these up as I showed you. We've looked at the chart, we've developed the bias, we've picked a spot, and now we can really, we can put ourselves in a good position. Let me add a couple more things here. Okay. So if we know our max loss, let's say we get out the theta switch is $85. Well, maybe you've got a tap out point, a a max loss of your own of, let's say, $250. Okay. Well, you could do basically three of these. Okay. You could do three contracts of this, one, two, three. And then that tap out point there, right around 250, is about 255 there. So you're a little bit over there. Okay. Well, so that's how you want to position size these things. Okay. Yeah. You'd end up making, in this case, $168. Okay. But you don't want to put yourself into peril here at $732. Okay. That becomes problematic. Okay. So that's what we call a bull put spread. So if we have a bullish bias on a stock and we believe it can go, or like I said, in this case, it can go sideways, it can go up, or it can go down, and we're happy go lucky, no problem there, right? If it goes down too far, then we got to close the spread and move on and do something else. Okay. Now, I want to reiterate the reason I can do cash flow now without this breaking out. Okay. If this breaks out, I'm going to want to get more bullish. I'm going to want to look more directionally biased. Okay. I might want to get more aggressive. Maybe I want to do a ratio spread or something else like that. If you don't know what ratio spreads are, go to talktrading.com. We got videos and shows on all that stuff. But if I see something directionally, I can get really, really aggressive. But in this case, I can't get aggressive yet, but I can still do this cash flow. I can create cash flow, and I can do that on a very regular basis. Okay. Now, it's not just a bullish thing. Okay. We can do a similar trade on bearish setups as well. Okay. Texas Instruments was one I was looking at from a bear perspective here. Okay. So overall, this is overall bullish, but recently, okay, the last, I don't know, 3, 4, 5 weeks there, this thing's just been getting absolutely beat down. Well, it's below all these important moving averages. This green one is a 200 period moving average. That is the line in the sand for a lot of investors. Okay, in the markets. Once it gets below the 200 period moving average, it gets very bearish. So it's got a little bit of a bounce here, closed above that there. It could get up to here, maybe a couple more days up. That's very possible. Okay. But if it hits this 200 and this falling 20, okay, that should act as, or could act as resistance. So, the likelihood of this going up, hitting this, and then falling is not, again, not guaranteed, but more likely than I would say, blasting through this on its first shot. Okay. So now we're looking at this from a bearish perspective, okay, instead of a bullish perspective. Okay. So for me, I don't want to get bearish as in I'm looking to short this on the way down, but could I set up a trade now and start collecting some cash flow by building a spread like maybe way out here? Well, that's what I'm looking at. And that's called the bear call spread. Okay. And so we can do this on bullish and bearish, but let's build out a bear call spread. Now, one thing we want to keep in mind, so we want to look and see when earnings is. Okay. So earnings is on January 21st. We want to make sure that this trade is closed before January 21st. Okay. And let me explain to the reason why. Okay. This up here is called IV rank. Okay. What this means is implied volatility rank. Okay. Implied volatility is one of the parts of the formula, the Black-Scholes model. It basically determines the premium of options. Okay. And so when implied volatility rises, the premium in options rise as well. Okay. When it falls, they decline. Well, for us, because we're selling premium, we actually want things to fall. Okay. So if we go through an earnings announcement, it's going to build into that earnings announcement and then it's going to fall out. We would like to be out of that trade before earnings. Okay. So having that in mind, if we go try to build a bear call spread here, I don't want to go to January 24th, because then I got to deal with the unknown nature of volatility and the earnings announcement, right? Maybe we get a huge gap, right? Huge gap like we had here on the last earnings. I don't want to be in that spread if I can deal with that. So instead, I can go out to my January 17th. Everything will be closed before the earnings comes, and we're good to go. So again, I'm just going to do an out of the money credit spread here. There's lots of other cool types of spreads to do. I like to do some in the money credit spreads. We'll save that for another day. But the out of the money credit spreads, again, I'm going to go look for closest to that 20 delta. So I got a 19 and a 21. Okay, so um, looking here now, this is interesting. So see this wide bid ask spread here. Okay, here it's pretty tight. Here it's a little bit wider. So here it's a little wider. These will widen. These will tighten up. Sorry, during market hours. So the numbers that we see aren't going to be perfect, but they'll be good enough for what we got to do. We at least have 4 million shares of volume traded, so that's good. And we can always look at our volume and open interest, and we can see that we have thousands of contracts here of volume and open interest. Okay, and now so this is very interesting. You'll notice. Okay, so the bid ask spreads of the round numbers are much tighter than the 2.5s. Okay, so that tells me that we need to trade either these round numbers, okay, with lots of volume, instead of these other ones, because this can be challenging. Okay, so just keep that in mind. Let's go back to our delta here. So for me, I look at this, I got a nice bid ask spread at 200 here. Well, if I go look at the 200 here, where's the 200? Look where the 200 is. It's way up here. Okay. It's giving me a very large cushion between the current price and where it's going to start to cause me heartache. Okay. And again, I've got these cushions here, right? This is very important. When I set up a credit spread, okay, I'm kind of front running this, right? I'm not waiting for it to roll over. I'm front running it because I do have these levels of resistance here. By the time this gets up to 200, this 50 period moving average should also act as resistance. There's probably other areas like right about here where I would say that there's a support and potential resistance as well. So I've got a lot of stuff here that can prevent this from getting to my short strike. So that's good news. Okay. So what I'm going to do is I'm going to sell this 200. Okay. Now I've got to buy something to protect it. Remember, okay, if I get a buck 74 for this and I just do a naked call, which is really, really, some brokers won't even let you do it, but that could be really, really challenging. Okay. It says the max loss infinite. Okay. That's a bad idea. You don't want to do that. Okay. So we never do that, right? What we want to do is we want to buy some insurance. Well, where's that insurance? Well, we're going to pick that insurance. So I can't do $3 wide, but I can do $5 wide. Okay. So I can buy this here. Okay. I can buy this here. Now I got to uncheck this, and it says the credit is 22 cents. Here's one of our rules. Okay. One of our rules is I need at least 10% of the spread. Okay. 10% of this spread to do this trade. Well, I'm not getting that. Okay. I'm not getting that. So automatically, this disqualifies this particular equity from doing this trade. Okay. So right off the bat, I'm like, you know what? Okay, this just kept me out of this trade. Now I should have looked at this earlier. The bid ask spreads were a little bit better when I did look at this. Okay, but now this is just untenable. Okay, so you may see a good setup, but your numbers may not work. So you have to kind of pivot. So let's look at something else here. So ARM Holdings here. Okay. So overall, look at our trend again. Okay, I'd say overall slightly bearish. Recently, very neutral. Short term, very bearish. Now, this is on a precipice. If it loses this 126 level here, it's probably going to get down to, might stop at 120, but it's probably going to get to 115 pretty quickly, right? So now, could this bounce here? Sure could. Don't know if it's going to or not. Okay, but it's testing this support. Tested it once, tested it twice. Okay, You could say that it was support back here as well. So if this falls through here, okay, my credit spread could look awfully good. But I don't know. It might just go sideways and it might go up. Well, as long as it doesn't go too far up, which if it does, it's got to deal with this 200, this 9, this 20, potentially the 50. So now can I build a bear call spread out of this? Well, let's take a look. Okay. So again, I want to make sure this is liquid, 8,500, 8,500,000 shares, 500,000 shares traded. So it's liquid that way. Are our options liquid? You betcha. Look at all these. Look at these options here. Lots of liquidity. Now, interestingly enough, okay, look at the strike prices. Tight bid-ask spreads, lots of that. Nothing in here. So we know right off the bat that these strike prices are challenging. So I might have to do, I might have to do a $5 wide spread on this. Okay. So now if I look at this, I want to go to the closest to 20 delta. Where's my 20 delta there? Look at that 20 delta way down there. So the 144. Okay. I might have to, let's go to the 145. Okay. So if I look at the 145, where does that take us? Well, look at this. If I do the 145, if I can get enough money, look at the 145, it gets me above all of this. That stock is going to have to hustle to get through all of this stuff. Okay. So let's see if we can build us a good trade. All right. So I'm going to sell the 145. Okay. And I'm going to go $5 wide because that's what it's giving me the opportunity. And I'm going to sell that there. And look at that. So I've got a $5 wide spread. Okay. I've got a 66-cent credit. I needed at least 50 cents. Well, I've got potentially 66 here. Okay. So let's see what this looks like. All right. Looks like I've already got another trade on there. Let's get rid of that. Okay. So now I've built up this trade here. Okay, where I could potentially make 66 bucks, but got, 434 bucks worth of risk. Again, we've got to make sure that we manage these. Okay, so my tap out points are the short strike of 145, the break even 145 and a half, or at the very latest, okay, 147.59, which is the theta switch. Those are the tap out points. All right. So again, if I'm getting out at the short strike, I'm risking about 157. Well, if my tap out, my max loss for my portfolio size is only 250 bucks, guess what? I can only do one of these. Okay? So just keep that in mind. You must position size properly. Okay? But this is, so again, let's add, so we'll move this to our short strike. We'll add another one here. Okay? And basically infinity, okay, we've got an 82% chance in this case that this stays above our short strike. I think we've got to move that over a little bit there. Okay, so 81.5% chance that this stays in there. So again, high probability, low reward, potentially a big problem if you let it go to max loss. Okay, and we don't do that. Okay, but again, we've got protection all the way up to, it's got to come all the way through this here. Okay, now can it do that? It absolutely can. It just makes it challenging. Okay, these moving averages tend to act as support and resistance. Okay. So this is why we like credit spreads. Okay. I don't need to be perfect on direction. If you're one of those traders out there that have been trading a while and you find it hard to pick direction, well, guess what? The credit spread itself allows you to be right on 3 of 4 directions, essentially. Okay. In this case, down works, sideways works, up a little bit works. Okay. The only one that doesn't work is up a lot. Okay. And so there's lots of things we can do to manage these trades as well. Okay. You don't have to wait till it hits your short strike either, right? If it got above these moving averages, maybe it gets to 140 there. Okay. So if we got up to 140 there, maybe you only risk 100 bucks. Okay. 110 bucks. Now you could do 2 contracts of this if your max loss was 250. Okay. So this is credit spreads. These are the very basics of credit spreads. The beauty of it is there's lots of different ways to do these. Again, if you're more aggressive on direction, you can always massage these. Okay. I'm showing you out of the money credit spreads here, But the reality is there's like I said, you can do at the money credit spreads if you have a specific view on the chart itself. You can do actually in the money credit spreads, which again, they're more directional in nature if you're more aggressive. Okay, there's lots of ways to do. The beauty of credit spreads, they can be high probability. Okay, you know, high probability, again, low reward. Okay, um, they're very versatile. You can maneuver them in a lot of different ways, and you can even put them together. So if we did a bear call trade and this started to go up, we could actually add a bull put to this, okay, and turn this into what we call an iron condor. And that's just one way to defend these things. The other part of this is, and maybe I'll do this in another webinar at some point in time, is there are about a half a dozen ways to defend these positions. It's another reason why I absolutely positively love credit spreads. Okay, they're so versatile. They're once you learn them, they're easy to put on. Okay, you can understand by looking at the risk graph. You can break it down. Like I said, you can massage these in a big way. You can turn them into iron condors where you get paid double the premium for the same amount of risk. There's lots of different things you can do here, but this is one of my personal favorite strategies just because it allows me to participate when I'm not super, super clear on the direction. I don't have to be right all the time. Okay. Anybody who says, that they pick direction right all the time, that's not been my experience. Okay. Even the best traders are, 60, 65, 70% of the time they get direction properly. Okay. If you're not in that category, credit spreads might be right up there. The other part of this is every day that ticks by. Okay. The one thing that I didn't mention about credit spreads here, and I guess I should. Okay. For those who aren't sure about the Greeks, if you're kind of new to this, okay, basically options kind of deal with four Greeks here. Okay. Vega is volatility. Theta is time decay. Gamma is the acceleration of our delta. Delta is directional. Okay. So if you see this here, we're doing a bear call spread on ARM. We are taking a directional position, a negative position, negative delta. Okay. We are a positive theta, meaning every day that goes by, we collect money out of this trade. So if you set up a bunch of credit spreads in your portfolio, you can get that consistent cash flow. It's another reason why credit spreads are awesome. Okay. Don't get me wrong. I like naked puts because they give us similar, consistent cash flow. The problem, as I showed you with naked puts, okay, if we go back to NVIDIA, and I did that naked put, they wanted to keep $12,600 for me to do a naked put. Well, I don't want to put out all that buying power. Okay, that's going to hamstring my account. But yet I can do a bull put spread like we did here. Okay, and they're literally only going to withhold what was it, $244? Sorry, max loss 44. So the buying power is 434. So I went from 12,600, and actually that was on one contract. Okay, on three contracts it'd be even worse. Okay, and I've knocked that down. So your risk, you're reducing your overall risk. You're allowing yourself the potential for consistent cash flow, and you can maneuver these trades in such a way, and you can massage them. Okay, I just chose the 20 delta. I know some folks who do the 30 delta, they're a little bit more aggressive. Again, all of these things are available when it comes to doing credit spreads, and that's why I love them. All right, that's what I got for you tonight. If you want to learn more about credit spreads, we do shows at Tackle all the time. We really dive in. I know I did a cash flow club a few weeks ago where we dove real deep into credit spreads, where I go into the hedging and the management of them, and really diving into it. So please check out tackletrading.com. Get yourself a 15-day free trial. Come check us out. You'll get to learn these strategies and a whole bunch more. And don't forget, Coach Matt, December 30th, he's going to be going through this is an event you need to register for. He's going to be going through the cover call process. That's also one of my favorite trades out there. So anyway, thanks for coming out, you guys. I super appreciate you. Have yourselves a great holiday season, and come check us out at tackletrading.com. Love y'all. Merry Christmas. Take care, everybody.